Are you a small business owner looking to save on taxes? You've come to the right place. In today's world, understanding the ins and outs of tax-saving strategies is crucial for small business owners. It's not just about keeping more of your hard-earned money, but also about ensuring your business is running as efficiently as possible. In this video, we will be exploring a variety of strategies that can help you save on taxes, including claiming tax credits, keeping accurate records, finding the right accountant, and many more. Each of these strategies is designed to help you reduce your tax liability and increase your bottom line. Remember, every dollar saved on taxes is another dollar that can be reinvested back into your business. So, are you ready to learn more about these tax-saving strategies? Great! Let's dive into the first tip: claiming tax credits. Tax credits offer dollar-for-dollar reductions in your tax liability. Just imagine if your tax bill totals $5,000 before credits, and you're eligible for a $2,000 tax credit, your final tax liability drops to $3,000. That's a $2,000 savings right off the bat. This is the magic of tax credits. They directly reduce the amount of tax you owe, dollar for dollar. Some credits are even refundable, meaning if the credit is more than you owe, you get the difference back. For instance, let's say you owe $4,000 in taxes, but you qualify for a $5,000 refundable tax credit. Not only do you owe nothing, but you'll also get $1,000 back. Now that's a win-win. So always look out for tax credits that your business might be eligible for. Now that you understand tax credits, let's move on to the importance of keeping accurate records. Maintaining accurate records of all your income and expenses is vital for managing your taxes. It's like putting together a puzzle. Each receipt and invoice is a piece that forms the bigger picture of your financial health. Record keeping is more than just a tedious task. It's your weapon against overpaying taxes. When you keep a clear and updated record of your income and expenses, you're arming yourself with the evidence needed to claim all the deductions you're entitled to. It's like having a map that leads you to hidden tax-saving treasures. Moreover, accurate records can shield you from penalties. Underpayment or late payment of taxes can be a costly mistake, but with proper documentation, you can avoid these pitfalls. Just imagine, with every receipt you keep, you're potentially saving dollars on your tax bill. It's not just about being organized, it's about being smart with your money. With accurate records in place, finding the right accountant can be your next step. Hiring a qualified accountant like our expert team at NE Accounting and Tax Solution can save you time and money. Imagine having your very own financial Sherlock Holmes. Our accountants possess the acumen to spot deductions and credits might slip past an untrained eye, translating this into significant savings for your business. They are like experienced navigators in the complex world of taxation, steering your business clear of errors in tax filings, ensuring that everything is submitted and on time. A missed deadline or a single mistake could result in penalties, which is something none of us want to face. Benefits of hiring our accountants go beyond just tax filings. They valuable financial advice, aiding you in making informed decisions that can positively impact your bottom line. Our team can also help you avoid common pitfalls, such as mistakenly reporting sales tax as income. Therefore, in the grand scheme of things, hiring our accountants is not an expense, but a significant investment in your business's financial health. Did you know sales tax is not considered income and should not be reported as such? Let's clear up this common misinterpretation. Sales tax is a state or local tax that you collect from your customers and pass along to the appropriate tax authority. It's not income for your business, but rather a responsibility you hold as a merchant in your jurisdiction. When reporting your income on your tax return, you should exclude the sales tax you've collected. Instead, it should be reported as a separate item. This distinction is crucial because including sales tax in your income could inflate your revenue, leading to a higher tax liability. Remember, your business's income is generated from the sale of your goods or services, not from the sales tax you collect. So, keep your income and your collected sales tax separate when it's time to file. Speaking of taxes, there's a great advantage for those purchasing new equipment or property: the first-year bonus depreciation. If you purchase new equipment or property for your business, you may be eligible for a first-year bonus depreciation deduction. This is a potential tax-saving gem that small business owners should consider. So what is first-year bonus depreciation? This is a tax incentive that allows a business to deduct a large chunk of the purchase price of eligible assets, such as machinery, equipment, or furniture, in the year the assets were put into service. The beauty of this deduction is that it can significantly lower your taxable income in that first year, giving you a hefty tax saving. Let's say you bought a piece of machinery for your business worth $50,000. With first-year bonus depreciation, you might be able to write off the entire cost in the first year of use, reducing your taxable income by the same amount. Now, you're well on your way to saving on taxes, but there's more. Let's assess potential tax deductions. There are many tax deductions available to small business owners. Are you claiming them all? Imagine a myriad of opportunities to reduce your tax liability, just waiting to be discovered. Let's delve into a few of them. One of the most common deductions is for home office expenses. If you're working from home, a portion of your rent or mortgage, utilities, and even insurance could be deductible. The key here is to ensure that the space is used exclusively and regularly for your business. Next on the list, we have vehicle expenses. If you're using your personal car for business purposes, you may be able to deduct expenses related to its operation. This includes things like fuel, maintenance, and even depreciation. You can choose between the standard mileage rate or actual expenses method, whichever works best for your situation. Travel expenses can also save you big at tax time. If you need to travel for business purposes, costs such as airfare, hotel stays, meals, and even tips can be deductible. Just remember to keep meticulous records and only claim expenses that are strictly business-related. What about education expenses? If you're taking courses or attending seminars directly related to your business, these costs can be deductible too. This includes tuition fees, books, supplies, and even certain transportation costs. And let's not forget about advertising and promotion costs. Whether you're running online ads, printing flyers, or sponsoring a local event, these expenses are generally fully deductible. So as you can see, there's a treasure trove of deductions potentially available to you. The trick is to stay organized, keep accurate records, and understand what's deductible and what's not. And finally, don't forget about the qualified business income deduction. This gem allows eligible small business owners to deduct up to 20% of their qualified business income from their taxable income. It's like a reward for your hard work and entrepreneurship. Remember, every bit counts when it comes to reducing your tax liability. So take the time to assess all potential tax deductions and make sure you're not leaving any money on the table. The qualified business income deduction can reduce your taxable income significantly. Now, what does this mean exactly? Well, in essence, it allows eligible small business owners to deduct up to 20% of their qualified business income from their taxable income. This deduction is a boon for those who are self-employed or own a partnership, S-corporation, or sole proprietorship. It's designed to level the playing field with larger corporations, which have historically had access to more tax benefits. But how do you know if you're eligible? The deduction is available to small businesses whose owners have a taxable income below $160,700 if single, or $321,400 if married filing jointly. Remember, this is just one of the many tax benefits available to small business owners. It's clear that understanding and implementing these tax-saving tips can make a big difference for your small business. So, are you ready to start saving on your taxes? Let's do a quick recap of the key points we've touched upon in this video. We started off by discussing the importance of claiming tax credits, which offer dollar-for-dollar reductions in your tax liability. We then moved on to the significance of maintaining accurate records of all your income and expenses. We also talked about the value of hiring the right accountant who can help you identify tax deductions and credits that you might have overlooked. We emphasized the need to avoid reporting sales tax as income, as well as the benefits of first-year bonus depreciation. We delved into the world of potential tax deductions and the qualified business income deduction. All these strategies can help you reduce your tax liability and ultimately save more money for your business. Remember, every dollar saved on taxes is a dollar that can be reinvested in your business. So, start implementing these tips today.